Welcome to today's explainer. Okay, imagine for a second that you're starting today with absolutely no investments, a relatively low salary, and nothing but your smartphone. What exactly should you do? Well, it's a question that plagues pretty much everyone trying to build wealth for the first time. So today, we're going to unpack a highly effective step-by-step blueprint. And this isn't just theory, it's based on over 40 years of actual market experience that has generated millions. We are literally taking you all the way from ground zero to a fully functioning, completely automated investment portfolio. Let's get you over that initial beginner anxiety and start building some real wealth. Okay, let's dive into this. We've got an incredibly clear roadmap today. First, we'll cover choosing your investing platform. Second, picking the right account. Third, the three-fund portfolio. Fourth, executing and automating trades. And finally, number 5, knowing when to sell. Section 1. Choosing your investing platform. Look, when you're first getting started, choice paralysis is very, very real. You don't know who's reliable, and you probably feel like you just don't know enough to make a smart decision yet. To make it easy, our source provides a really strict, simple checklist for picking a platform. First and foremost, you absolutely want Financial Services Compensation Scheme, or FSCS protection. That basically means if the platform itself goes bust, your money is actually protected up to £120,000. You also definitely want low fees, access to tax-advantaged accounts like ISAs, and an interface that's actually easy to use. Based on all that criteria, Trading 212 is highlighted as the preferred platform, especially since it covers over 100 countries globally. Now, when you go to actually verify your account, just be prepared. You're going to need a valid photo ID, your national insurance number, which, by the way, you can easily find on a payslip or a tax document, a proof of address like a utility bill, and you'll need to snap a quick selfie for security. Any regulated platform has to ask for these things, so don't be alarmed by the whole process. Moving right along to Section 2, picking the right account. So the crucial point is this. Picking the wrong account type on day one can literally cost you thousands of dollars in totally unnecessary taxes down the line. Let's methodically break down your options here. First up, the general investment account. It's standard, sure, but you're going to be hit with a 10 to 20% capital gains tax purely on your profits. Next is the CFD account, which is mostly used for day trading. Honestly, just walk away from this one right now if you're a beginner. It's incredibly high maintenance, and like 80 to 90% of day traders actually lose money. Then we have the absolute goldmine, the stocks and shares ISA. This is a tax-advantaged account where your profits are completely tax-free. Now, there is a massive myth holding beginners back regarding the £20,000 limit. People actually think you can't have an account balance over £20,000 or that you can't earn more than that. That is totally false. The limit only applies to what you deposit per tax year. You could grow that portfolio to over $1 million, and you still wouldn't pay a single cent of tax on the profits. Finally, there's the cash ISA, which does offer tax-free interest, but historical data shows its growth is typically way lower than investing in an index fund. So for our blueprint today, the stocks and shares ISA is the undeniable winner. Section 3. The three-fund portfolio. Instead of trying to outsmart the entire market by picking thousands of individual stocks, our source recommends a highly reliable strategy loved by the Bogleheads, which is this community inspired by Vanguard's founder, John Bogle. It's explicitly designed to survive recessions and completely remove the anxiety of stock picking. But okay, to really get it, we first need to define what a fund actually is. In plain English, just think of a fund as a massive basket filled with lots of different companies. By buying just a single share of this basket, you instantly gain fractional ownership of all the companies inside it at the exact same time. It's basically instant diversification. And this brilliantly illustrates how this whole portfolio comes together for a young investor with a moderate risk tolerance. You essentially split your money into 3 distinct baskets. 55% goes into a U.S. stock index fund, like the S&P 500, which gives you a piece of America's top companies. Then 35% goes into an international stock fund, covering companies across Europe, Japan, and elsewhere. Finally, that last 10% is allocated to a bond fund, which really acts as your shock absorber. Buying bonds is basically lending money to the government for a small, steady return, and it really helps to smooth out the wild ups and downs of the stock market. Because young investors have decades to wait out potential market crashes, they can comfortably afford this kind of stock-heavy approach without totally panicking. All right, Section 4, executing and automating trades. So you have your platform, you have your account, and you have your strategy. Now comes the moment of truth, actually hitting that buy button. It's an incredibly exciting, yet kind of terrifying moment. You're becoming a part owner of the biggest companies in the world. But yeah, the fear of losing money is very real. Fortunately, modern platforms allow for fractional investing, meaning you can invest just a tiny amount of money into a highly valuable stock or fund to get your feet wet. But when you do, you're going to be confronted with some confusing jargon like market and limit orders. Let's demystify this right now. A market order tells the platform, hey, buy this right now at whatever the current price is. It executes instantly as long as the market is open. A limit order, on the other hand, says, only buy this if the price drops to this specific maximum amount. While a limit order technically gives you more control, it might not execute at all if the stock never drops to your price. So here is the comforting truth for a long-term investor. You really don't need to overthink this. Small price discrepancies today will absolutely not matter 20 years from now. A simple market order is more than sufficient to execute your strategy. Now, when you're searching for your index funds, you're frequently going to see the words accumulation or distribution in the name. The absolute best piece of advice for this blueprint is to keep things incredibly boring and totally automated. Always, always choose accumulation. What this does is ensure that any dividends those companies pay out are automatically reinvested right back into the fund, buying you even more shares without you ever having to lift a finger. Okay, prepare to have your mind blown a little bit by the sheer power of this automated consistency. According to historical data projections from our source, if you auto-invest just £250 a month into this 3-fund portfolio for 20 years, your total out-of-pocket investment would be $61,000. But through the sheer magic of market growth and compounding, your portfolio could realistically project out to a staggering $262,000. That right there, that is the ultimate motivation to go set up your auto-investments today. And finally, Section 5, knowing when to sell. Let's move to our final point and see how this all builds together. While the source jokes that his sell button is broken because he prefers to hold things forever, the reality is holding a stock for the wrong reasons can cost you just as much as buying a bad stock to begin with. Sometimes selling is absolutely crucial to protect your wealth. Honestly, there are only 3 main valid reasons you should ever actually hit that sell button. Number 1, the momentum is dying. Number 2, you genuinely need the capital for a much bigger opportunity. Or number 3, the broader market has fundamentally shifted against your investment. To understand that first reason, dying momentum, you kind of have to realize that stocks move based on 3 distinct types of value. First, there's fundamental value, which is based on real math, actual assets, real revenue, and solid profits. Then there's trading value, which relies on short-term chart patterns. But then you have momentum value, and this one is driven almost entirely by internet hype and human emotion. This is incredibly dangerous. The source cites the historical example of Lemonade Inc. It was heavily pumped by influencers online, but when the underlying reality of the business finally set in, the price completely collapsed. Refusing to sell just because of a stubborn diamond hands culture when the hype is clearly dying, that's a guaranteed way to lose everything. If you ever see a stock surging on pure hype, it is often a really wise move to sell 30 to 40% of it just to lock in your profits before the inevitable crash. As for that broader market shifting against you, listen, blind loyalty to a stock will only cost you money. The stock doesn't know you own it. You have to look for major warning signs. Is the company bleeding market share to some new disruptor? Has the management team committed fraud? Is the entire business model becoming totally obsolete? The source brings up some brilliant historical examples of knowing when to cut ties. Like Warren Buffett aggressively selling airline stocks during the COVID lockdowns because the long-term outlook completely crumbled, or dropping Tesco the second an accounting scandal broke trust, or even consider traditional print media. When smartphones launched, print was basically doomed, and the smartest investors sold off immediately. But outside of those very specific selling scenarios, for the vast majority of your 3-fund index portfolio, this is the ultimate takeaway right here. Time in the market beats timing the market. Mathematical compounding literally does not care if you are motivated, it doesn't care about your opinions, and it certainly doesn't care about your emotions. It only responds to unyielding consistency. The investors who win big in the end aren't necessarily the smartest or the fastest, they are simply the ones who set up a system and stay invested through all the noise. And that brings us to the ultimate question you have to ask yourself before you even begin. Armed with this beginner's blueprint, when the market inevitably dips, and trust me, it absolutely will you panic at the first drop and sell, or will you trust the system, stay boring, and let time work in your favor to build your fortune? The tools are literally right in front of you. The next step is entirely yours to take. Thanks so much for joining me for this explainer, and I'll see you next time.